Welcome to the world of accounting.
Well, hello and welcome. Hopefully as you're watching this video, it is after 9 a.m. and you've had your mocha coffee latte. Although, come to think of it, after that opening, you might not need the latte. In any case, with any luck, we've grabbed your attention. And so, as you have certainly deduced by now, this video is about accounting. Accounting. More than likely, the mere utterance of the word conjures images of damned rules and definitions, unwieldy hordes of numbers, states of confusion, and most certainly boredom. But underneath it all, as we'd probably all have to agree, accounting is the backbone of commerce. Accounting allows businesses to know where they've been, where they are, and how they've done. Accounting, moreover, helps business to determine where they're going and how they might want to proceed. And therefore, gaining a better understanding of accounting could only be a benefit to us all. And so the humble goal is for us all to learn everything we need to know about accounting, including how to prepare financial statements from scratch in less than an hour. Impossible, you say? Don't be so sure, for as the saying goes, when the student is ready, the master will appear. And he has appeared, a master who will help us to put all of our doubts and anxieties aside, a master wise in the ways of accounting who will restore us to balance. Presenting to you now, the Honorable Accounting Master, Zen Frog.
Relax, accounting wisdom seeker. Accounting is balance. The yin, the yang, and a few simple concepts.
And so with the assistance of the great accounting master, we shall undertake to accomplish the following. Familiarize ourselves with the pillars of accounting, create a company, analyze and record the transactions for that company, construct a general ledger and a trial balance, and prepare financial statements for the company. And then we might end with a few other topics to close. And so to begin, let's once again consult the great master.
Pillar of accounting number 1. Assets equals liabilities plus equity. Cowabunga.
Yes, assets equals liabilities plus equity. Indeed, the foundation of modern accounting. So let's take a moment and make sure we understand each of the terms of this important equation, beginning with assets. As most of us probably understand, an asset is a resource owned by a company which has future economic value that could be measured in dollars. Simple enough, but let's take just a minute to pay special attention to that one word in particular, and that is future, as in having value in the future. Clearly, if we're buying a building, we can use that building for many years. The same with equipment. And of course, when we buy inventory, we do so to sell it and realize its value, plus some profit, hopefully, in the future. But what about expenditures for things like plane trips, one-time advertisement in the daily newspaper, salaries, or utility bills? Rather than deriving future value from these purchases, we use or consume them and they're gone. That is, for example, we buy a plane ticket to visit a customer, and once we use the ticket, is no longer of value because the value has been consumed. Likewise, when we pay a utility bill, the electricity or gas has already been used. The point we're making here is that expenditures for items like plane tickets and utilities and other goods and services that are consumed and hold no future value are in fact not assets but expenses, a category of expenditure we'll speak of more later. So, continuing on, in addition to assets, we have liabilities. And what are liabilities? Well, as you know, liabilities are generally obligations of a company and typically relate to amounts owed to creditors for goods and services received but not yet paid for. When you get a phone bill at home or a credit card bill, these are liabilities. Fair enough? Good. And finally, we come to equity. And what is equity? Well, for now, let's define equity as the residual interest in the assets of an entity after deducting all the liabilities. An example will make this all quite a bit more clear. So, you want to buy a house for $200,000. If you didn't happen to have $200,000 laying around, you might go to a bank and get a mortgage, and in doing so, you would incur an obligation, namely an obligation to pay the money back to the bank with interest. Let's say the loan is for $150,000. So we have an asset in the form of a home, certainly a home has future value, and we have a liability in the form of an obligation to repay the bank. The difference is the residual value or equity. Notice that equity is a measure of residual value. It is not a pile of cash or anything tangible. We can't go somewhere and count it, but more about that later. Okay, so we have a good grasp on the first pillar of accounting, assets equals liabilities minus equities. Let's see what other wisdom the great Zen master has to share.
Accounting. It is the way of the buckets. Every transaction must be placed in its proper bucket.
Ah, yes, the way of the buckets. And that makes sense. And really all the master is telling us is that you wouldn't get much value from just knowing the total value of all the assets that a business had. Rather, we want some precision, some granularity. And so we set up buckets or accounts for a number of categories. For example, we can have a bucket where we record all of the cash transactions of business, all of the ins and outs. We might record all of the transactions related to the equipment owned by a business using another bucket or account. Of course, it would also be useful to have some specific information about the liabilities a business might incur. For example, we might want to differentiate between accounts payable and maybe a mortgage whose balance is not due for many years to come. Okay, you get it. But the master does insist on being thorough. And speaking of a mysterious master, I wonder where in the world he might happen to be now.
Remember balance, yin and yang. For every debit, there is a credit. Debit plus, credit minus.
Well, now we know we are really talking about accounting. Debits and credits? Indeed, this is where most people's understanding of accounting begins to tail off. But really, there's nothing very difficult here, especially if we listen carefully to the words of the master. Debits plus, credits minus. That doesn't sound all that scary, and really it's not. As long as we simply remember this. If we want to record an increase or an addition to an asset type bucket, we record a debit in the form of a plus. If we want to record an increase in a liability or in an equity account, we record a credit and represent that credit as a minus. The debit is a plus, the credit is a minus, and for every debit there must be a credit for the same amount, so the two offset each other, and so we are always in balance. Here's an example. Let's assume you have a new business and you decide you need a computer. You find one online for $50 and call the vendor and tell him you would like to purchase the item. The vendor tells you he is in the neighborhood and that he will send a delivery person over immediately. The computer arrives and you are presented with a bill that indicates payment is due in 10 days. Okay, a slightly unrealistic scenario, but it'll do nicely for our purposes. You want to record the transaction, so how do you do it? Well, you know that the computer will have value for at least a few years, and so the computer is an asset. You also understand that you have an obligation to pay the vendor, which means you have a liability. You further know that to increase the balance of an asset account, you record a debit in your books, and a debit is a plus. And finally, you know that for every debit, there must be a credit, that an increase in a liability, such as an accounts payable, indeed requires a credit, and that credits are recorded as minuses, and voila, your first accounting entry, or journal entry, to use the accounting vernacular. You got it. Awesome. Looks like the Zen master is still a bit skeptical. Well, let's do another quick example. You find $25 in the coat pocket of your old winter jacket. You decide you want to put that money into your business bank account. You go to the bank, you make your deposit. Now, to record the transaction. Well, let's see. We want to record an increase in cash. Okay. And cash is clearly an asset. And so to increase an asset, we record, right, a debit. Correct. And debits are always shown as a plus or positive. Okay, halfway home. So we need a credit. And in this case, the credit will be to owner's equity. Why owner's equity? Well, by putting in cash, the residual value of our business has increased. Increasing an equity account is done by recording a credit. And since credits are recorded as minuses, booyah, journal entry number 2. Nice. So let's do a quick summary of what we have learned. Assets equals liabilities plus owner's equity. Oh, by the way, you want to see that equation in action? Check this out. Let's look back to our 2 journal entries. And we see that we have 2 assets, the computer for $50 and the cash from the equity investment for $25. We have 1 liability, namely our accounts payable to the computer vendor. And finally, we have 1 entry in the equity bucket to record the cash investment, and that was for $25. Note, our debits and credits are properly recorded as pluses and minuses, and now we just add. Plus 50 plus 25 is a positive plus 75, while minus 50 plus a minus 25 is negative 75. We have plus 75 on the one side, a minus 75 on the other, and hey, what do you know? It balances. Cool, right? All right, one more thing to point out. Remember, we said that accounts that had to do with revenue and expenses we would treat as components of the equity bucket. Here's what we mean. If we want to record an increase in revenues, we record it as a credit, which means we record a minus in the books. This is counterintuitive, right? I mean, a minus to record a good thing like revenue, but it's really not. What you are recording really is an increase, that is a credit, to equity. So if you think of an increase in revenue as an increase in equity, it does make a bit more sense. In any case, in a similar manner, when we want to record an increase in an expense, we record a debit, which as we know, we show as a positive entry. Well, if that is not all perfectly clear, do not worry. We will have a lot of opportunities to practice our debits and credits in just a moment or 2. Anyway, on with our story. So, secure with our knowledge of accounting and in keeping with the American dream, we decide to open our accounting business. What? It could happen. Anyway, we open our doors for business, and in no time, a neighbor from across the street enters our accounting office. The gentleman explains his name is Keith, that he's opening a martial arts gym, and that he needs our accounting services. We agree on the terms, and Keith presents us with some of his financial information, such as his bank statement, his credit card statements, and some invoices he has received and submitted. Sorting through all this data, we are able to figure out that the martial arts business has engaged in the following transactions. And therefore our goal is to use our extensive accounting knowledge and experience to account for each of these transactions. Now, as we know, very little accounting is done by hand these days, and most accountants today avail themselves of the multiple benefits of technology. They purchase and learn the latest, greatest accounting software and live happily ever after, at least during those times when they're not on hold with the software provider's understaffed and uneducated customer service support line. All well and good. But what is important to know is that no matter how elaborate the accounting software, fundamentally all that accounting software really is a big multifunctional spreadsheet. And so let's look inside of our computer and record these transactions in a spreadsheet of our own. So here we have the first few columns of our accounting spreadsheet, including a good handful of accounts or buckets waiting to be populated. And to assist us, you'll note that the accounts are separated and color-coded, with the asset accounts appearing first in green, the liabilities appearing next in red, and the equity accounts coming last, highlighted in gray, with the income statement accounts showing up in a slightly different shade of gray. This will be a help. So, Let's have a look at our first entry. Okay, here we can see that Keith initially funded his business with a deposit of $3,000 of cash into his business checking account. Now, you might remember that we have actually already recorded a transaction similar to this. That's right. This is the same sort of transaction as the one we recorded to report our finding that $25 in our winter jacket pocket. Okay, so what do we have here? Well, looks like we need to increase cash, which is an asset, by $3,000. We recall that an increase in an asset is a debit, and that debits are recorded as a plus. And so let's put a $3,000 plus in the cash bucket. And since every debit needs a credit, well, this $3,000 is going to fund the business. And that, as we recall, is an equity transaction. Looking over at our reference sheet, we're reminded that an increase in equity is recorded as a credit. Credits are minuses, and boom. Debit cash, credit equity, and we can see that indeed these two entries zero out, and therefore we are on balance. Awesome. Next transaction. Okay, it looks like Keith's friend gave him a loan. And since a loan means we have received cash, and since we definitely know how to record an increase in cash, let's go ahead and place a positive $2,400 debit in the cash bucket. But what next? Well, by taking a loan, we've incurred an obligation. An obligation to a business is a liability, and we know that when we want to record an increase in a liability, we use a minus credit entry. And that credit goes right there in long-term loan accounts. Great. But what about the interest? Well, we have only just received the loan, so no interest is accrued, and so we'll come back to that a little bit later. Great. Okay. Moving on then. Looks like Keith has purchased some equipment, mats, punching bags, mirrors. Those things will hopefully be around for a few years, and so we'll record these items as equipment assets. Once again, an increase in an asset requires a positive debit entry. Now, Keith didn't get the equipment for free. In fact, he had to shell out $900 of cash. But wait, that means we are reducing an asset. We've never reduced an asset before. We know how to increase an asset with a debit, but what do we do with a credit? That's right, we do the opposite. If we increase an asset with a plus debit, we decrease an asset, in this case, the asset being cash, with a minus or a credit. And there it is. And note, we still have a debit and a credit, a plus and a minus, and once again they offset, leaving us with a zero balance. Just what we're looking for. Life is good. Okay, what next? Keith appears to have purchased a sign for the front of the building. The sign will last a few years, and so we are working with an asset, and again, just like the previous entry, we're using our cash. That is, our cash is decreasing. So the entry, debit leasehold improvements, to record an increase in that asset bucket, and record a credit or a minus to cash, since our cash is being decreased by the price of the sign. Get it? Got it? Good. We're rolling. Next, Keith purchases 5 martial arts uniforms wholesale. He's planning to sell these to his students at a profit. That is to say, Keith is building or increasing his inventory of uniforms for sale. Increase inventory? And inventory is an asset. Sounds like we need to debit inventory for $100. And that's just what we do need to do. And again, just like the last couple of entries, we're decreasing our cash. A decrease in an asset is a credit. That is a minus. Done and done. Ah, cool. Looks like Keith's got his first student who paid $40 for a month of lessons. No problem. We're experts in recording an increase in cash, so debit cash. But wait, now what? Well, what's the cash for? Well, lessons. And since Keith is in the lessons business, that money represents revenues. A quick look at our reference sheet, and we're reminded that an increase in revenue is to be recorded as a credit denoted with a minus, debit cash plus 40, credit revenue minus 40. We're good to go. Okay, this is a little trickier. What do we do when Keith sells a uniform from his inventory to a student? Well, the word sells or sales screams revenue, so let's start there. We record a $30 credit to increase revenue. And as for our debit, well, that is easy. We just received cash, increased cash, $30 with a positive debit. Perfect. But unfortunately, we're not quite done. Why? Well, don't forget, even though we bought the uniform for $20 each and sold one for $30, that is to say that we have to record the fact that we are now only holding 4 and not 5 uniforms in inventory. And if you're thinking that to decrease an asset, which in this case is inventory, we need to record a credit or a minus, you're exactly right. Again, the uniforms were 20 each, so we take one out of inventory with a $20 credit. But wait, now we are out of balance. We need a $20 debit. What do we debit? Keith sold a uniform for $30. The uniform cost $20. So to show the net profit of 10, we need to record an expense. And the expense bucket we use when we are talking about the sale of inventory is cost of goods sold. So we debit cost of goods sold for 20, and once again, all is right in the world. And speaking of expenses, it looks like Keith bought some beverages and other supplies. Well, since Keith plans on giving away and not selling the beverages, they surely won't last very long, and so it looks like we better treat the beverages and supplies as an expense. And what do we do to record an expense? We know this, that's right. Record a debit in the appropriate bucket. And for our credit, well, looks like Keith paid cash, so we reduce or credit cash with a minus for the same $60. Next, rent for the martial arts dojo or studio. Easy, rent is clearly an expense we are paying for in cash. A plus debit to expense for $100, a minus credit to cash for $100, and we are moving on. Okay, this is a bit more challenging. Keith purchased advertising, and advertising is certainly an expense, which we record in the month we do the advertising. But he didn't purchase only a month of advertising, he purchased 6 months at once. What do we do now? Well, let's start with what we know, and what we know is Keith spent $60 of cash. So at least we could record that. Decrease cash, credit cash, $60. But our entry is off $50 at this point. How do we resolve that? And the answer becomes clear when we realize that we have 5 months of advertising coming to us. That is, we have future value still to derive from our investment in advertising. And in particular, we have $50 worth. Therefore, we have an asset. Assets like this, where amounts are paid up front for services to be received later, are called prepaid expenses, or in this case, prepaid advertising. And so there's our entry. Asset increase, prepaid 50, and balance is restored. One $60 credit and 2 debits, one for $10 and one for $50, adding up to $60, even Steven. Moving right along. Okay, this sort of transaction is familiar. Keith bought a ceremonial sword for use in black belt celebrations. The sword's price was $15, but like the computer we purchased in our earlier example, we have 30 days to pay. And so we record a debit to the asset bucket called equipment for the plus 15. And rather than a credit to cash, we record an increase in a liability, which is also a credit, specifically a credit to accounts payable, minus 15. On to the next transaction. 10 kids enroll in the school, paying for 2 months each. Looks like martial arts is getting popular. But how do we deal with all of that? Tell you what, let's start with the low-hanging fruit by recording the $800 increase in cash. And by now we could do that with our eyes closed. Debit cash $800. Easy. Now, as was the case earlier, lessons mean revenue, so we know there is revenue to be recorded. But the kids paid not for 1, but for 2 months. Well, we can't record 2 months of lessons in a single month, just like we would not record 6 months of advertising expense in 1 month. So what do? Well, let's at least record 1 month of lessons with a credit to revenue. Now, after the month, we have $800 which we received for lessons, but we have only delivered $400 worth. We still owe $400 of lessons to the kids. That is to say, we have an obligation to teach them. Wait, obligation as in liability? Yes. And we call such an obligation deferred revenue. Deferred because we have to defer recording the revenue until we actually deliver and earn it, satisfying our obligation. The entry, deferred revenue, a liability, credit 400. So, let's sum up the transaction. Debit plus 800 cash, credit minus 400 to revenue for the lessons we give during the month, and a minus 400 credit to the liability account, deferred revenue, to record the obligation to teach lessons in the future for which we have already received payment. Whew, well, we got there. Home stretch. Keith repays $100 of the loan and pays a month's worth of interest. Okay, pays equals a reduction in cash. In this case, a reduction of $100 for the principal and $24 for the interest relating to the loan. Result, credit, negative $124 to reduce cash. Now, with that out of the way, let's look at the interest payment. Interest is an expense, and often a dogged one. We know how to deal with that, and that's right, a debit to expense plus 24. And finally, about the loan repayment. Well, by repaying the portion of the loan, we have relieved part of our loan obligation. Well, if an increase in an obligation or a liability requires a credit, a decrease logically would be recorded using a debit, and so debit long-term loan by plus 100. Well, this is interesting. It looks like the investors on CNBC's Shark Tank think that Keith's business is interesting and have invested $500. This kind of transaction is old hat to us. Debit to record the cash increase, credit to record the increase in equity, plus 500, minus 500. Moving right along, looks like Keith paid himself a dividend. Well, the easy side of that entry, of course, is a credit to cash for $500. But what about the other side? Well, a dividend is really a direct withdrawal of equity, and so to record that reduction to equity, we post a debit to dividends. And finally, it looks like the invoice arrived early, and Keith wrote a check for the sword that we recorded earlier. Well, half of the entry is easy. We enter a credit to cash for minus 15. And then, what's the other side of the entry? Well, as in the case of the loan repayment, we are paying up on an obligation, and in this case, we are repaying the obligation in full. And so the entry is debit AP for plus 15, thereby reversing the obligation, and we're done. But look at this. By recording all these transactions in this manner, we've actually created a general ledger for Keith's Martial Arts Gym. Wait, what? How? Well, all a general ledger is a complete record of financial transactions over the life of a company. And since Keith has only been in business 1 month, and we've just recorded all of the business transactions, by definition, we have created its general ledger. But actually, it gets better, because we have also simultaneously prepared a trial balance for the business. And how did we do that? Well, simple. A trial balance is a statement aggregating all the debits and credits in a double entry accounting book listed by account. In other words, if we add all the debits and credits in each account and come up with a net balance for each account bucket, we will have a trial balance. And here it is, a complete and accurate trial balance for Keith's Martial Arts. And you did it. Okay, one last step, and really it's going to be easy. Using our trial balance, we need to prepare an income statement and a balance sheet for Keith's Martial Arts. Wait, come on now, don't be reaching for the stop button. This is easy. All we have to do is move our totals from our trial balance into our financial statement templates, and we're done. So let's do it. Starting with the income statement. Now note the heading for period 12/1 to 12/31. Please remember, when we are speaking about an income statement, We are seeking to understand how a business performed over a specific period of time. We want to know what was earned, what was expensed, and what the resulting income or loss was for the period. This is different from balance sheet, which gives us a look at our assets, liabilities, equities as a snapshot in time. Here's an example. If someone asks you how much cash you have, you open your checkbook and you read the total as it stands at that time. On the other hand, if you wanted to know how much money you made last year, you would look at your W-2 and note that for the period 1/1 through 12/31 you made X dollars. Get it? Awesome. Anyway, on to the income statement. Beginning with revenue. We did not specifically break it out, but you remember that Keith sold $440 in lessons and then recorded another $30 of revenue from the sale of that uniform. $440 plus the $30, $470, just like it says in the trial balance. Okay, next. Cost of goods sold, $20, good. Remember, everything for the most part is coming over as a positive number. We are no longer dealing with debits and credits, you'll be happy to know. Then we pick up the balances for the rent, advertising, supplies, and interest expense. Subtract the expenses from the revenues. A beautiful income statement prepared from scratch by you, reflecting the fact that Keith's business recognized $256 of net income during the month of December. And by the way, keep that 256 net income figure in mind. We're going to need it again. Okay, one statement down, one to go, the balance sheet. And here, all we really have to do is the same thing. Pull over and input the balances from our trial balance, beginning with cash and other current assets. Then we pull over and show the assets that will most likely not be converted into cash within the next year, specifically our equipment and our leasehold improvements. We then move to the other side to post our liabilities and our equity balances. And then, oh, stop. Wait, what's the deal with this retained earnings thing? Well, the definition of retained earnings is really quite telling. Retained earnings are the net earnings of a business which are not paid out as dividends but retained by the company to be reinvested in its core business. What does that amount in our case? Well, since we are showing the dividends paid to Keith as a separate deduction to equity for training purposes, retained earnings equals the total earnings of Keith's martial arts since inception, which, according to the income statement that we just prepared, is $256. Enter that into retained earnings, total it up, total assets, $5,971, total liabilities plus owner's equity, $5,971, and we are in balance. One beautiful balance sheet, done and done. Well, that just about wraps up all we wanted to cover in this video. But just as a matter of housekeeping, let's just have a look at one more thing. As you recall, the balance sheet is a snapshot of the assets, liabilities, and equities of the business at any one time. All these accounts accumulate, increasing and decreasing over time as business is conducted. On the other hand, when it comes to things like sales and expenses, we want to start the account over again each month or quarter or year. And so what we need to do is record an entry to set these income statement accounts back to zero. And we can do that thusly. We begin zeroing out the balance in revenue by way of recording against the $470 credit balance a $470 plus debit. We do the opposite with expense accounts to zero them out. Once this is done, we are ready to carry our closed out trial balance and general ledger over to the next period. And so as we see here, we have zeros in our trial balance for our income statement accounts as of January 1, 2015, and we are ready to begin the whole wonderful process again. And so there you are. You are now full-fledged accountants. You created a company, recorded its financial transactions, you produced a general ledger, trial balance, and ultimately a balance sheet and an income statement. Well, what do you have to say about that, Honorable One?
You have learned well. Now go and seek your accounting destiny.
And there you have it. It's been an honor being with you today, and I thank you so much for your time and attention, and thank you, of course, for being a valued member of the BKE team. Until next time, I bid you peace and balance.